Welcome back, everybody, to another deep dive into
Yes,
some more
exactly.
fascinating financial stuff.
Right.
Today, we are looking at IFRS 15.
Okay.
Now, I know that sounds
Uh-huh.
really, really dry,
Yeah,
but stick with us.
absolutely.
Because
Okay.
this is one of those things that, affects,
Impacts everything.
everyday life, and you don't even realize it.
Yeah, for sure.
IFRS 15 is all about revenue recognition.
Uh-huh.
And it is like the global standard for how companies
Oh.
report their earnings.
Yeah,
So that is
really important.
hugely important for
Yeah.
anyone who's analyzing financial statements or
Mm.
trying to invest,
Yeah.
or just even understand a complicated business deal.
That's right.
So yeah,
Yeah.
we're gonna break down the 5 key steps of IFRS 15 today.
Okay.
Using lots of clear examples
Yeah.
to make it, easy to understand.
Perfect.
So step 1 is all about identifying the contract.
All right.
Which
On
sounds
the
like-
basis of it all.
Yeah, super simple on the surface.
Right.
But I'm guessing there's more to it
Oh, yeah,
than meets the eye.
for sure. There's nuance in accounting.
I don't
Always
know.
nuances.
So under IFRS 15,
Yeah.
a contract can actually be established in 3 ways.
Okay.
Written, verbal, or even through standard commercial practices.
That's right.
So
Yeah.
even if there's no fancy paperwork,
Uh-huh.
a simple handshake
Could be a contract.
or a long-standing way of doing business could still be
Absolutely.
a binding contract.
Yeah.
Interesting.
Yeah.
But
Yeah.
there are 2 key requirements for a contract to be valid
Oh.
under IFRS 15.
All right.
One, it needs commercial substance.
That's right.
So it can't just be a theoretical agreement.
Yeah, just right there.
It has to have
Like a real impact
a real impact.
on future cash flows. So that's the commercial substance piece.
Right.
And then the second piece is there must be an exchange of assets,
Okay.
like money changing hands for a product or service.
Gotcha. So it's not just about a promise.
Right.
There has to be an exchange of value.
Yeah, exactly. An exchange of value.
So
Right.
give me an example then of commercial substance that's a little
Okay.
more exciting
Sure.
than
They're like buying a cup of coffee.
yeah.
Yeah. So
What if I sign up for a software subscription?
that's a perfect example.
Okay.
Yeah, because you're paying a subscription fee.
Yeah.
And in exchange, you're getting access to the software and all its benefits.
Right.
So there's an ongoing exchange of value,
Okay.
which demonstrates commercial substance.
Gotcha.
Yeah.
So
Yeah.
let's say we've identified a valid contract.
Yep.
What happens next?
Well, then we move on to step 2,
Okay.
which is all about identifying the performance obligations within that contract.
Performance obligations.
Yes.
Break that down for me.
Okay, so think of a performance obligation
Sure. Yeah.
as a promise within the contract
Yeah.
to deliver something of value to the customer.
Gotcha.
So it could be a tangible product like a phone
Right.
or a service like a software subscription or even a combination of both.
Okay.
Okay.
So if I sign up for a software subscription.
Yeah.
And it comes with initial training sessions,
Yeah.
that would be.
2 separate performance obligations.
Okay.
Because you've got the software access itself is one,
Right.
and then the training sessions are another.
Okay.
And that's important because each performance obligation
Uh-huh.
needs to be accounted for separately when it comes to recognizing revenue.
Okay. So we're starting to see
Great.
how this all ties back to
A bottom line.
yeah, okay.
Okay, great.
So let's get even more specific.
Okay.
What if I buy a new phone
All right.
that comes with a 1-year warranty? Is that 1 or 2 performance obligations?
That's a great question.
Wow.
And it highlights a key distinction under IFRS 15.
Okay.
So the phone itself
Yeah.
is clearly a performance obligation,
Okay.
but a manufacturer-provided warranty is actually treated differently.
How so?
It's considered a liability for the company
Okay.
because they're essentially setting aside money
Right.
to cover potential repairs
Yeah.
within that warranty period.
So they're basically
They're promising to stand
promising to stand
behind their product.
behind their product.
Yeah.
Okay. What if I buy an extended warranty separately? Is that still a liability?
That is where it gets interesting because
Yeah.
that separately purchased extended warranty is treated as a distinct performance obligation.
Wow.
So it's a separate promise to provide service beyond the standard warranty. And the company can recognize revenue from it separately.
So it's not just about, like,
Right.
what's included.
Yeah.
It's also about...
Whether it's an inherent part of the product
Or like an additional service.
or an additional service you're
Or
choosing.
I'm choosing, yeah.
Yeah.
So as a consumer, this means I should pay attention to
Absolutely.
whether a warranty is included or if it's an extra cost.
Yes, because it could impact how the company is accounting for that revenue.
That's really interesting.
It is.
Okay, this is already making me rethink
I know, right?
how I look at, like, product bundles and warranties.
Yeah.
All right, so let's keep this IFRS 15 train rolling.
Okay.
What's the next step?
Next step is we got to figure out the transaction price.
Oh.
So that's step 3.
Transaction price.
Yes.
That sounds pretty self-explanatory.
It does.
Isn't it just like
The price tag.
the price?
Right.
Okay.
Yeah. Sometimes it is that straightforward,
Okay.
but often there's more to it.
Okay.
So the transaction price is the amount of consideration
Okay.
a company expects to receive in exchange for fulfilling those performance obligations.
Yeah. Gotcha.
And to get that number right, we need to consider 2 things.
Okay.
Fixed consideration and variable consideration.
Okay. I'm intrigued.
Yeah.
Tell me more about this.
Okay.
Like fixed versus variable consideration.
All right, so
What's the difference?
fixed consideration is the easy part.
Okay.
That's the agreed upon price stated in the contract.
Okay.
Think of it like the sticker price on that new phone you were looking at.
Right.
But then we have variable consideration. And this is where things get a bit more nuanced.
Okay.
Variable consideration refers to any aspects of the price
Mm-hmm.
that might change
Okay.
based on certain factors.
So things like...
Discounts, rebates,
Yeah.
or even performance bonuses
Gotcha.
that could impact the final amount the company receives.
Okay, so as an investor, this means I should look beyond, like,
Absolutely.
just the headline price.
Yes.
And consider these variables
Yeah,
when evaluating a company's, like, revenue projections.
that's right.
Yeah, because a company that relies heavily on variable consideration might have, like, less predictable revenue streams.
You're exactly right.
Okay.
It's a crucial factor to consider when assessing a company's financial performance.
Wow, this is making me realize how much strategy goes into, like,
I know.
revenue recognition. Okay, so we've identified the performance obligations.
Yes.
We've determined the transaction price,
Correct.
factoring in those, like, tricky variables.
Yeah.
What's next?
Okay, so step 4 is all about allocating that transaction price
Okay.
to each of the individual performance obligations.
Okay.
We can't just lump it all together anymore.
Right, because in that phone example, we've got the phone itself, and then that separate
The extended warranty.
extended warranty, each
Yeah.
with their own distinct value. So how do we divide the total price fairly between those two?
We use what's called a standalone selling price.
Okay.
So essentially, we need to figure out what each item or service would cost if sold separately.
Gotcha.
And then each performance obligation gets a portion of the total price based on its relative standalone selling price.
So it's like figuring out the market value of each piece of the puzzle?
Exactly.
But what if a company doesn't actually sell those things individually?
Right.
How do they determine those standalone prices?
That's a great question.
Okay.
So there are a few methods companies can use.
Yeah.
They might look at market data for similar products or services.
Okay.
Or use cost plus calculations,
Mm-hmm.
or even rely on their best judgment based on available information.
Gotcha.
So it's all about coming up with a reasonable and consistent approach.
Okay.
Yeah.
Let's walk through like a specific example just to make sure
Yeah.
we're on the same page.
Yeah.
Let's go back to our like
Telecom bundle.
telecom bundle
Yeah.
example.
The phone plus the 1-year network plan.
Yeah, exactly.
Okay.
So let's say the company charges $25,000 for that bundle.
Okay.
And let's assume, based on market data,
Yeah.
that the phone itself has a standalone selling price of $20,000.
Okay.
And the network plan costs like
$1,000 a month.
$1,000 a month.
Okay.
Gets purchased separately.
So the total standalone value of both items would be $32,000,
Right.
$20,000 for the phone, and $12,000 for a year of the network plan.
Right.
Yep.
So how do we use this information to then allocate the
Well,
$25,000 bundle price?
We look at the proportions.
Okay.
So we essentially create a ratio based on those standalone prices.
Okay.
So for the phone, the allocation would be
Yeah.
$20,000
Mm-hmm.
divided by $32,000.
Of course.
multiplied by the $25,000 bundle price.
Right.
Which gives us $15,625.
So even though the phone might seem like the bigger part of the deal, it actually
accounts for a slightly smaller portion of the revenue.
Of the revenue.
Because its standalone price is proportionally lower.
Yeah.
And for the network service, then the calculation would be
$12,000.
$12,000.
Divided by $32,000.
Yep.
Multiplied by the $25,000.
Bundle price,
which comes out to $9,375.
And of course,
and if you add
$15,625 plus $9,375,
those together, you get your
equals our
$25,000.
$25,000.
Yeah,
it all adds up.
It does.
So we've now successfully allocated the transaction price to each performance obligation.
We have,
which brings us to
the moment of truth.
The moment of truth.
The grand finale.
Step 5.
Yes.
Revenue recognition. After all this groundwork, when can a company finally say, we've earned this revenue?
That's the question everyone wants to know the answer to, right? Yeah. So according to IFRS 15, revenue is recognized when the customer obtains control.
Control.
Yes.
Okay, help me understand what that actually means in like real world terms.
Okay, so think of it this way.
Control means the customer has the ability to direct the use of.
Okay.
And obtain the benefits from that good or service.
Okay.
So they have the keys to the kingdom, so to speak.
So it's not just about like physically handing over a product or completing a service.
It's about
the customer needs to have like
full ownership.
Yeah, full ownership and the right to
use it and benefit from it.
Use and benefit from it. Yeah. Okay, and there are a few indicators that can help determine when control has transferred.
Okay.
For example, like
a legal transfer of ownership is a strong sign.
Or if a customer has like
accepted a product or
service.
Meaning the return period has expired.
Right.
That's another good indicator.
Okay.
And of course, the transfer of risks and rewards associated with the asset is crucial.
Okay. I'm starting to see how this all comes together. But let's go back to our telecom bundle one last time. Right.
When would the company recognize revenue for the phone and the network service?
Let's assume the phone comes with a standard 7-day return period.
Okay.
The company wouldn't recognize the $15,625 allocated to the phone until after that 7-day period is ended, confirming the customer's acceptance and control.
So they need to be sure the customer isn't going to return the phone before they can
claim that revenue. Yeah.
What about the network service?
Okay, well, since the network service is provided on an ongoing basis, the revenue is recognized monthly as the service is delivered.
Okay.
So each month, the company can recognize $781.25.
Okay.
Remember, that was the portion of the bundle price allocated to the network service.
Right.
As the customer receives and uses the service.
So even within a single bundle, we can have like
different revenue recognition timelines?
Depending
on when control is transferred. Wow, that's pretty nuanced. It is. But I have to say, after walking through these 5 steps, I'm already starting to see the world of business transactions with a new level of awareness.
That's the power of IFRS 15.
Yeah.
It really is.
It's like I've been given this X-ray vision for financial statements.
I love it.
But before we get too carried away,
we need to talk about why this matters to you.
Yeah.
Not just to the companies reporting their earnings.
You're right. We can't leave our listener hanging without understanding the so what.
That's right.
Like, we've gone deep into like the mechanics of IFRS 15, but why should anyone, besides an accountant, really care about this stuff?
Because understanding IFRS 15 gives you, as an investor or even just a savvy consumer, a much clearer picture of a company's financial health.
Okay.
You can look beyond the top-line revenue numbers and understand the timing and quality of those earnings.
So instead of just taking a company's word for it, when they announce like
record revenue,
I can dig a little deeper.
Absolutely.
And ask, and
say, how did you get to that number?
But how did you get to that number?
Yeah.
And is it sustainable?
Is it sustainable? Exactly.
Yeah.
You can start to assess whether that revenue is front-loaded, back-loaded, or spread evenly over time. You can analyze their contracts and see if they're relying heavily on variable consideration, which might make their future earnings less predictable.
I'm starting to see how powerful this is.
Yeah.
It's like having a secret decoder ring
It
for financial statements.
I love that analogy.
But can you give me like a specific example of how understanding IFRS 15 could help me as an investor?
Okay, so let's say you're looking at two software companies.
Okay.
Both report strong revenue growth.
Okay.
But one company recognizes most of its revenue up front, while the other recognizes revenue over the lifetime of the customer contract.
Okay.
Which company would you be more interested in?
Well, knowing what I know now about IFRS 15, I'd be more inclined towards the company that recognizes revenue over time.
Okay, why?
Because that suggests to me that they have like
a
more stable
and
predictable revenue stream.
That's right.
Which is generally a good sign.
Exactly.
Long-term growth.
Long-term growth, and it's a sign that they're building lasting customer relationships and generating recurring revenue.
Yeah.
The other company might be making a big splash with upfront sales.
Right.
But what happens after that initial burst?
Right.
It's something to investigate further.
Yeah, this is making me rethink how I evaluate companies.
Yeah.
I've always focused on revenue growth.
Yeah.
But now I'm seeing the importance of understanding like the quality of that revenue and how it's being recognized.
Absolutely.
Yeah.
And it's not just about investing.
Okay.
Understanding IFRS 15 can also make you a more informed consumer.
Okay, how so?
Well, think about those complex bundled deals we often encounter.
Yeah.
Like when you buy a new phone with a service plan or a software package with a bunch of add-ons.
Yeah.
By understanding how companies allocate prices and recognize revenue from these bundles, you can better evaluate whether you're getting a good deal.
So if I'm looking at a software bundle, I can now ask myself, okay, how much of this price is actually tied to the core software that I want?
Exactly.
And how much are they tacking on for these extra features?
You might not even use.
That I might not even use, right? It empowers you to like break down those bundles and see if the pricing is truly aligned with the value you're getting.
That you're receiving.
I'm starting to see IFRS 15 lurking everywhere.
It's everywhere.
It's like this secret code.
It is.
That unlocks this deeper understanding.
Deeper understanding.
Of not just financial statements, but like
the whole world of
the entire world of like business transactions. I have to admit, I came into this deep dive thinking it was going to be all about like debits and credits and like mind-numbing technicalities.
Right.
But it's turned out to be so much more than that.
It really is.
Yeah.
It's about empowering you to ask the right questions, to see through the smoke and mirrors, and to make more informed decisions about where you put your money in your trust.
I feel like I've been given a superpower.
Yeah.
The ability to see the financial world with a new level of clarity.
That's right.
But before we wrap up this deep dive, I want to leave our listener with like something to really think about.
Okay.
We've talked about how companies use IFRS 15.
Right.
And how understanding it can like make us smarter investors and consumers.
Yeah, for sure.
But what are some specific questions that our listener can start like asking themselves?
Okay.
When they encounter like a company's financial reports or even just a complicated product offer?
That's a great point. It's one thing to understand the concepts.
Yeah.
But it's another to actually apply them in real world situations.
Exactly.
Yeah.
So let's say I'm looking at a company's like latest earnings report.
Okay.
What are some IFRS 15 related red flags that might make me like dig a little deeper?
Well, one thing to watch out for
okay,
is a significant mismatch between a company's reported revenue and its cash flow.
Okay.
So if a company is recognizing a lot of revenue but not generating a lot of cash, it could be a sign that they're aggressively recognizing revenue up front.
Okay.
Or that they're having trouble collecting payments from customers.
That's a really good point.
Yeah.
It's a reminder that revenue isn't always the same as cash in the bank.
That's right.
What else should I be looking for?
Okay. Pay close attention to how a company describes its contracts and performance obligations.
Oh, okay.
Are they clear and transparent about how they're recognizing revenue?
Right.
Or are things a bit vague and confusing?
Okay.
If a company's being evasive or overly complex in its disclosures, it could be a sign that they're trying to hide something.
So clarity and transparency are always good signs.
Absolutely.
So like they're saying, hey, we have nothing to hide.
Exactly.
Here's exactly how we're doing business.
Here's how we operate.
Yeah.
Yeah.
And if you're ever unsure about something, don't hesitate to reach out to the company directly.
Absolutely.
Or consult with like a financial professional.
Yes.
good advice.
Okay.
Yeah.
That's a great reminder. We don't have to figure this all out on our own.
You don't have to.
Okay, now let's shift gears a bit.
Right.
And talk about how we can use like IFRS 15 knowledge as consumers.
Okay.
What are some questions we can ask ourselves when we're faced with like a bundled deal? First and foremost, ask yourself if you truly need all the elements of the bundle.
Right.
Are you being swayed by a seemingly great deal?
Yeah.
When in reality, you're paying for things you won't actually use.
Okay.
Remember, companies often use bundles to make their offerings seem more attractive. But it's up to you to determine if the value proposition aligns with your needs.
Yeah, that's so true. I've definitely fallen into that trap before.
I think we all have.
Getting lured in by a bundle,
Yeah.
only to realize later that I'm paying for a bunch of stuff I don't need.
Right, exactly. Another important question to ask is, what are the standalone selling prices of each element of the bundle?
Right.
Do some research and see if you can find those items sold separately.
Okay.
It'll give you a benchmark for evaluating whether the bundled price is truly a discount.
Right.
Or just a clever marketing tactic.
Yeah, I love that. It's about like taking back control.
Yes.
And not letting companies like dictate
the terms.
the terms of the transaction.
Of the transaction, that's right.
Yeah. By understanding the principles of IFRS 15, you can become like a more savvy consumer.
Absolutely.
Negotiating from a position of knowledge.
That's right.
And ensuring that you're getting the best possible value for your money.
I love it.
This has been such an eye-opening journey.
It has.
We started with like what seemed like a dry accounting standard. And we've ended up with like a whole new perspective on how businesses operate.
Yeah.
And how we can participate in the financial world in a more informed and empowered way.
Absolutely.
It's amazing how these like seemingly technical concepts can have such a profound impact on our like everyday lives.
It's true.
So to our listener out there,
yes,
remember IFRS 15 isn't just for accountants.
No.
It's a powerful tool that can help you make smarter decisions. Whether you're evaluating a company's financial performance or just trying to navigate the complexities of a bundled deal.
That's right.
Keep asking questions, stay curious, and never stop learning.
Couldn't have said it better myself.
And on that note, we'll wrap up this deep dive.
Okay.
Until next time, stay informed and stay empowered.
Sounds good.